Well, I'm getting tired of talking about the same thing week in, week out, but unfortunately, that's the market we're stuck with. Hi there, everyone. Welcome to the Traders Circle Weekly Market Update. Today is Tuesday, the 30th of July, 2024. And before I get started, you do need to be aware that whatever I say is general advice only, and you have to consider whether it's appropriate for yourself. So the big news for the next week, week and a half, 2 weeks even, is the Australian CPI reading for the second quarter. That's going to come out tomorrow morning, 11:30 a.m. Australian Eastern Standard Time. And then the following Tuesday next week, we're going to see the RBA meeting for August. Now, CPI is expected to come in a little bit stronger than last time. It's expected to be around 3.8% headline CPI, and the trimmed mean CPI is expected to be around 3.9 to 4%. That number hasn't really dropped over the last 6 months, and it shows that inflation is still remaining fairly strong. Now, given that number, if it was in isolation, I think the RBA would be considering lifting rates further, lifting rates from where they currently sit. And that's because very little progress has been made on bringing that inflation down, especially over the past few months. However, there's quite a lot of things that maybe give me a bit of reason to believe that they might hold off on raising rates further this time around. The first thing is that a lot of the items in the CPI that have been going up or remaining fairly sticky, they're not really things that interest rates will bring down. They're not things that are going to sort of be a direct response to the cost of borrowing going up. We're talking about things like inflation. We're talking about things like healthcare costs. These sort of items that in some ways have mandated price increases, higher education costs, for example. We're not really going to see them be brought down by higher borrowing costs, at least not in the short term. So that's the first thing. The second thing is that our data has been quite mixed. Some things are still very strong. We had fairly strong jobs numbers. We had fairly strong retail sales last time around. But some things have been a lot weaker than expected. And so just today, for example, we had far lower than expected building approvals. They do risk doing some economic damage. And I've always believed that some economic damage will need to be done, but they do risk doing, perhaps a bit too much economic damage if they lift rates further. Regardless, if CPI is stronger than expected tomorrow, we're talking 4% or more from the headline, and maybe 4.1% trimmed mean CPI. I think we will see a rate rise on the 6th of August there. Now, perhaps another reason that the RBA may consider holding off rates is actually that we're in a bit of a different position than the US. So the US is actually looking to cut interest rates fairly soon. Almost everyone expects they'll cut at their September meeting. They will actually have a meeting this week from the Federal Reserve. The Fed's not expected to cut this week, but they are expected to signal that September cut. And given that the US is starting to look to cut, that's another reason that our RBA might decide to just hold. Because if the US cuts, in some ways, it is kind of like a small rate rise for Australia. What I mean by that is, our interest rate becomes relatively more attractive compared to the US rate, compared to other rates around the world. That could cause a bit of strengthening in the Australian dollar, that could reduce imported inflation, and in some ways it might be sort of like a small rate rise if we hold and the US cuts. Regardless, that expected cut in the US is helping to keep their market strong. Obviously, they've seen a series of all-time highs this year, and it's acting like a bit of a carrot dangling out in front of markets. Historically, markets have rallied really strongly in the lead up to rate cuts. And why shouldn't they? Stocks love lower borrowing costs. Investors love lower borrowing costs. Leverage investors can borrow at lower costs and buy more stock. So stocks do love, interest rate cuts. However, historically, we've seen rallies up until the point of rate cuts, and then markets tend to sell off after the rate cuts. Whether that's going to be the case this time around, it's very hard to say. But I do think markets remain extremely expensive. They're extremely overpriced. And they will sell off at some point. It's just about trying to find out what's going to trigger it. Another potential reason for a bit of a sell-off could be earnings results. So we've seen pretty mixed earnings in the US. They are sitting around their average beat rate, so it's not a particularly positive or negative season. However, we have seen earnings results that have appeared fairly positive, be sold off by the market. So I'm talking about things like Alphabet or Google's results. There's been quite a few others. I think JP Morgan, for example, stocks that have reported fairly well and then still being sold off by the market. And that's just a factor of just how high those share prices are. A good result, a small beat is not enough to keep them powering higher. And no surprise, these shares have rallied an immense amount. They are extremely expensive. And even if they do achieve, what's expected of them, their share prices still look very expensive on a historical basis. For our own market, we're also about to start our company earnings reporting season. It's expected to show full year earnings decline for our market of probably around 6%, at least according to Macquarie's analysts. A lot of this is going to come from the materials sector with lower iron ore prices, but also banking earnings are expected to drop by about 2.5% as well over the year. Those material stocks have been sold off quite heavily. So they really have factored in lower earnings, lower dividends, and weakened performance. Well, it'll be interesting to see what their shares do when they do report results. And Rio Tinto, the mining stock, will actually be the first reporting company. They're going to report on Wednesday night, tomorrow night after market. So it'll be interesting to see what the market response to that is. The other thing that'll be interesting to see is the banking space. Like I said, banks are expected to report lower earnings this year, yet their share prices have jumped extremely strongly since last year. I think they're up about 30% over the past 12 months, and that's on declining earnings. So it'll be interesting to see what the market response to that is if they do report lower earnings. If our banks do roll over from here, given where the miners currently sit, our market will see significant selling. There's no two ways about it. And we can see that when we look at the chart. I'll bring up the chart of the XJO. This is our market, and it's jumped quite strongly in an uptrend since October last year. We bottomed out around sort of 6,800, and about a fortnight ago we hit 80 index points. A huge gain of almost 20%, I believe, and that's in a period where we've seen earnings decline. A lot of this is a belief that interest rate cuts are going to come from the US and perhaps for our own market, but like I said, that view could be disrupted over the coming fortnight. Technically for our market, we are inside a pennant pattern. We've got perhaps a short-term downtrend that's formed, we've got a longer-term uptrend, and then we've got a support level at 7,900. If we break below 7,900, break below 7,850, we're then looking at the uptrend line, probably around 7,750 at the moment. If we break above this short-term downtrend line, we're looking back towards the all-time high at 80 index points. The technicals at the moment sort of indicate more of a sort of sideways movement in the short term, but I would suggest that the next movement for our market will be determined by the events of the next 2 weeks. So that's the CPI reading tomorrow, that's the RBA meeting next Tuesday, and that's the start of the company earnings reporting season. If we have a look at the US market, we can see they've also seen some profit taking creep in over the past fortnight. I'll just wait for the chart to load a bit here, and they're also perhaps inside their own pennant pattern. They've got the longer term uptrend since October last year, they've got a short term counter trend down, they've got a bit of support at 5,400, and they're about to sort of head to the point of that pennant. If they break above 5,500, that's probably suggesting a move back to the all-time high at 5,675, and if they break lower, we could see a move all the way back to 5,250. US markets technically look more bullish than our own market, and I would suggest that the fundamentals are more bullish for the US market as well. Regardless, if the US keeps rising, our market will probably find it hard to sell off. So I will wrap it up there for this week, guys. Hopefully you enjoyed. If you did, give us some love in the comments, click like, click subscribe, and we'll see you next time.